In 38 seconds, $219 billion vanished. I didn't hesitate. I didn't call for a committee meeting. Freeze it, all of it. The weight of a decision like that doesn't hit you when you make it. It hits you 38 seconds later when the screens flash red and you realize there's no taking it back. My name is Jerome Powell, Chairman of the Federal Reserve. And on March 10th, 2023, I made a decision that collapsed markets, triggered a banking crisis, and changed American finance forever. But moments like that don't start with a bang. They start with a phone call at 6:47 in the morning and a sick feeling in your stomach. March 10th, 2023. My office at the Eccles Building in Washington, D.C. The sun hadn't risen. My coffee was getting cold. My phone rang. Michael Barr, Vice Chair for Supervision. His voice was steady, but I could hear that slight crack in composure. Jerome, we have a problem. Silicon Valley Bank just reported a $1.8 billion loss on securities sales. Their liquidity is collapsing. Depositors are pulling funds faster than we've ever seen. Full-scale bank run. I didn't say anything for 3 seconds. Silence is a tool in this job. But here's what I was thinking. If Silicon Valley Bank goes down, it's not just one bank. It's the 16th largest bank in America. The financial backbone of the tech industry, venture capital firms, startups, payroll accounts for thousands of companies, $209 billion in assets. And if depositors lose faith, they'll start pulling money out of every regional bank in the country. That's not a bank failure, that's contagion. That's 2008 all over again. Michael, I said, how much time do we have? Hours, he said, maybe less. I stood up, walked to the window. Thousands of people going about their morning, completely unaware their financial system was teetering on collapse. You don't get to wait for perfect information in this position. You get fragments of data, worst-case scenarios, and a clock counting down, so I made the call. Freeze their assets immediately. Invoke emergency authority. I want every dollar locked down until we assess the full scope. Do it now. There was a pause. Jerome, if we freeze their assets, we're confirming to the market that SVB is insolvent. We're triggering the panic we're trying to prevent. I know, I said, but if we don't act now, if we wait even one more hour, the damage will be exponentially worse. We freeze the assets, we buy time, and we contain this before it spreads. Do it. The call ended. I looked at my watch. 6:51 a.m. Markets opened at 9:30. The decision I made in that moment would trigger a cascade nobody predicted. Let me tell you what happened in those next 38 seconds. The order went out. Silicon Valley Bank's assets, all $219 billion frozen. Trading halted. Withdrawals stopped. Then the news hit. Bloomberg, Reuters, CNBC, Wall Street Journal, every outlet lit up. Federal Reserve freezes Silicon Valley Bank assets. 38 seconds after the freeze went public, the Dow dropped 427 points. The S&P 500 plunged 2.1%. The Nasdaq fell 2.8% in less than a minute. Trading algorithms saw the words Federal Reserve, freeze, Silicon Valley Bank, and sold everything. Bank stocks collapsed. First Republic dropped 61% in a single day. Signature Bank fell into crisis within hours. PacWest, Western Alliance, hemorrhaging value. Investors weren't asking questions, they were running. But here's what makes that moment critical. It wasn't about Silicon Valley Bank anymore. It was about trust. The banking system runs on one principle, trust. You trust your deposits will be there. You trust the bank isn't taking reckless risks. You trust regulators are watching. The moment I froze SVB's assets, I sent a message to every depositor in every regional bank. Your money might not be safe. Once trust breaks, the system doesn't crack. It shatters. Within 3 hours, $42 billion in deposits fled regional banks. Not just SVB, every bank that looked remotely similar. The contagion I tried to prevent was happening anyway. Faster, more violently, and here's the part nobody understands. I knew this would happen. Not exactly like this, but I knew freezing SVB's assets would trigger panic. I knew it would send shockwaves. I knew it would cause pain, losses, fear. But I also knew something else. If I didn't act, if I let Silicon Valley Bank collapse without intervention, if I let depositors lose access, if I let the 16th largest bank fail in chaos, the alternative would be worse, exponentially worse. So I made the call, and I watched the markets burn. Let me tell you what it's like sitting in the Federal Reserve building, watching every screen flash red, the Dow dropping 800 points by midday, CNBC predicting the next depression, knowing you made the decision that started it. It's not guilt, it's responsibility. Millions of retirement accounts losing value, businesses can't access capital, employees wondering if they'll get paid, all because of a decision before sunrise. But here's what I need you to understand. Freezing Silicon Valley Bank's assets wasn't about saving one bank, it was about saving the system. SVB failed because of a fundamental mismatch. They took billions in deposits during the pandemic when tech was flush with cash, and they invested it in U.S. Treasury bonds, the safest investment in the world. But they bought long-term bonds when rates were near zero. Then I raised rates 11 times between March 2022 and March 2023, the fastest hiking cycle in modern history. Why? Because inflation was out of control. If I didn't tighten monetary policy, we'd face runaway inflation that would destroy savings and devastate working families. So I raised rates, and when rates go up, bond prices go down. SVB was sitting on $120 billion in securities that had lost significant value. They were fine as long as they didn't sell those bonds, as long as depositors kept their money, as long as nobody panicked. But then the tech industry contracted. Startups burned through cash, venture capital dried up, depositors started withdrawing, not because they lost faith, they just needed the money. SVB had to sell bonds at a loss, $1.8 billion loss. That's when the panic started. The run began Wednesday night. By Thursday, $42 billion in withdrawal requests. By Friday morning, insolvent. I had a choice. Let it fail in chaos or freeze it and contain the damage. I chose containment. The markets collapsed. But here's what happened next. Within 48 hours, we had a plan. The FDIC stepped in. We invoked systemic risk exceptions. We guaranteed all deposits, not just the insured $250,000, all of them, every dollar. We sent a message, your money is safe. We will not let you lose access to your funds, and we created the Bank Term Funding Program, emergency lending that allowed banks to borrow against treasury bonds at par value, even if market prices had fallen. We gave banks liquidity, time, a lifeline. Slowly, the panic subsided, the contagion stopped, markets stabilized. Within 2 weeks, the S&P recovered most losses. Within a month, depositor confidence returned. Within 3 months, the crisis was over. But here's what nobody talks about. We didn't bail out Silicon Valley Bank. We let it fail. Shareholders lost everything. Executives lost their jobs. The bank ceased to exist. What we protected was the system, the depositors, the businesses, the employees, the startups. We protected the fabric of the economy. Yes, it cost money. Yes, it required emergency interventions. Yes, it raised questions about regulation and oversight. But the alternative, letting SVB collapse without intervention, letting depositors lose access, letting the panic spread unchecked, that would have cost more. In dollars, jobs, economic devastation. I've spent my career in finance, investment banks, Treasury Department, Federal Reserve Board in 2012, chairman in 2018, and I've learned something fundamental. The hardest decisions are the ones you make with incomplete information, under extreme pressure, knowing that whatever you choose, someone will suffer. When I froze Silicon Valley Bank's assets on March 10th, 2023, I knew the markets would crash. I knew the headlines would be brutal. I knew people would question my judgment. But I also knew the right decision isn't the one that prevents pain. It's the one that prevents catastrophe. 38 seconds. That's how long it took for the markets to collapse after my decision went public. But in those 38 seconds, in that chaos and fear, we bought something invaluable, time. Time to assess damage, time to craft a response, time to prevent a crisis from becoming a catastrophe. That's what leadership means in moments like this, not the popular decision, not the easy decision, the decision that gives you a chance to fix what's broken before it destroys everything. The financial system is fragile, more fragile than most realize. It runs on trust, on confidence, on the belief that tomorrow will look like today. When that trust breaks, when confidence evaporates, the system can collapse faster than anyone thought possible. My job is to maintain that trust, to ensure that when you deposit money, it's there, to ensure businesses can borrow and repay, to ensure the economy functions, not perfectly, not without pain, but functions. On March 10th, 2023, I made a decision that collapsed markets, but I also prevented something far worse, a complete loss of faith in the American banking system. And if you ask me today, with hindsight, with all the criticism and second guessing, if I would make the same decision again, the answer is yes, without hesitation. Because in this job, you don't choose between good and bad outcomes. You choose between bad outcomes and catastrophic outcomes. And that Friday morning, with the sun barely risen and the weight of the entire financial system on my shoulders, I chose the path that gave us a chance. 38 seconds. That's all it took for everything to change. But in those 38 seconds, we drew a line. We said, this far and no further. We said, we will not let panic destroy the system. We said, we will act. And we did.